if we start to think about that, first off, we know how to make money.
Mm-hmm.
That's got us there in the first place. Now we're thinking about how do we protect that money? How do we protect it from the biggest wealth destroyers, which are erosion and division, erosion from taxes. And by the way, not just estate taxes. There's an application there because they are absolutely looking at income tax erosion. How do we offset that? How do we be very efficient with our income taxes? Any other wealth transfer type of erosion? And then division, which is simply getting the money into the wrong hands at the wrong time. So guardrails and making sure that the biggest, what I didn't mention is the wealth destroyer is not bad investments. It's these other things. That's not why families lose generationally go broke. It's not bad investments. It's bad structure because they're thinking about a different time horizon. So if we think about what do the Rockefellers do, what do the Vanderbilts do, if we distill down what really was the difference, it was structure. They kept the money together. They protected it from erosion and division. There was a lot of division on the Vanderbilt side, right? And that destroyed it over a period of time, a lot of wealth. The same thing can happen with families that don't have Rockefeller and Vanderbilt money, Bezos money, so on and so forth. You sit there and go, if I do not have the right horizon in mind, and I'm not thinking about that, I'm just thinking about what's the S&P going to do this year. It's done 22%. What else is going to do? Like you're just not thinking on the same time horizon. So I think that's an important thing for us to start to think about. And then,
so most people are thinking retirement
mm-hmm.
and seeing if they don't outlive their money. Like, and if we're being honest, most people are thinking, I want to retire and die with money still left over.
Mm-hmm.
But usually that's as far as people think. And you're saying the difference between wealthy families that are doing these planning is they're thinking like 3 or 4 generations or longer, which is totally different than am I going to have enough money 20 years from now?
Yeah. They also, this is a very interesting difference too. They think about their family structure differently than we do. So a lot of us look at our family tree and say, here's my parents, here's my siblings, here's me, and we all operate individually. And maybe we inherit something from the parents or grandparents, but they're looking at it and saying, these are all family resources. How's everybody contributing for the good of the family? So then investing in education, if that's important, guess what? That's not dependent on my branch of the tree to invest in education. That's important to the whole family. So the tree is, for lack of a better term, instead of a bunch of branches, we're a trunk. Like what's important to you is important to the family, and the family invests in that, and the family has their resources together. So that's a very different thing. So there's a lot more communication, a lot more transparency. There's not usually a lot of communication and transparency, but especially about financial things amongst the different branches of our family tree. So there's a barrier there. There's a mindset there that changes when you start to think generationally.
What else have you learned from working with family offices and how they think? And
well, if you think about, we just talked about long-term, totally different time horizon, totally different view of family resources, then yes, there's a life insurance component that helps mitigate some of that risk. And hey, guess what? It creates liquidity. Liquidity replenishes the family reserves and helps make sure like it's happening at the end of a lifetime. Well, the end of the lifetime was our other timeline.
Yes.
This is going into the next timeline. And if
so
we're looking at...
when you say liquidity, you're saying they're looking at life insurance to say when daddy passes, the capital, the death benefit that's on dad's life is going to then create liquidity for the structures in place for the family.
Yeah. And so in the early years, and for these families, it's going to create liquidity that can be used to swap assets to a trust, to pay estate taxes so we don't sell off assets. There's a whole thing there that's not necessarily applicable for all of us. But what is applicable for all of us is we have liquidity that's created at the end that doesn't care about what else happened with the other resources. So we spent them, we lost them, we invested poorly, they got taxed heavily. Hopefully we address a lot of those things, but regardless, we got some liquidity here. Then we put guardrails around it. So trusts, irrevocable trusts, do have a play in non-estate tax planning because they can create guardrails. So if we think about what we were talking about earlier, hey, we got to the end of my life and now my kids are inheriting money, they're just getting it distributed. That's the division aspect. So we just divided it out, the wealth's gone. Based on what each branch does with their own resources, because they're not family resources, they're branch resources, right? So if we think about that, now they're thinking about it as like we replenish that. Yes, we pay estate taxes, but this family, if we have guardrails there, now we can invest in the family beneficiaries, into their resources, into education, invest into good business ideas, invest in things that benefit the family because we have a pool of capital that we're keeping together because we're thinking more like a tree trunk, not branches.
Good. That's good. I like that. Yeah, I appreciate what you shared about liquidity. And I'm thinking maybe the best example that maybe ordinary people watching this could be is like the house. Like you're instead of having to maybe sell a house, you have liquidity and you can choose, do I want to sell the house or not? But you're not doing it because you have to get every affairs in order.
Yeah.
I would imagine that a lot of these people have businesses and the liquidity gives the family options for how they pay estate taxes and all, because if you didn't have that in place, you may have to sell a very non-liquid asset at a very bad valuation because of maybe the owner, the founder is no longer alive. Like it's just not only are you taking a loss, but you're taking a loss on an asset big time at a season that you're probably not thinking the best.
Absolutely. One of the things that good planning in general, I'm going to generalize here, is good planning leads to better family harmony, period. And I think most families want family harmony. They don't want any sort of residual wealth to tear the family apart. And so if you have good planning, it can help with that. Touching on business owners for a second, passionate about buy-sell agreements. So if you're doing all of this, we're not going to unpack that other than the fact that if you are doing a great job on your estate plan and you've got a family office, you absolutely have things like your business buy-sell agreements buttoned up. You've got your triggering events defined. You've got your valuation language defined. You probably have it funded with life insurance because that's going to help with the family harmony aspect of how to settle that out. So it's all I'll talk about there because I love talking about buy-sell agreements, but that it plays right into that. It's like good planning, family harmony.
All right, so with these families that are using family offices, are they looking at life insurance for the infinite banking benefit? Or like explain to me like how life insurance is integrated?
Sure.
Because again, a lot of people love life insurance and the legacy is kind of like a asterisk. Like, yeah, I'm glad I have legacy, but they're mainly valuing it because of pooling capital and being able to use it. I would imagine wealthy families value the liquidity aspect of the cash value less than the actual death benefit that they're getting.